Hello, everyone. Welcome to video 5 of chapter 7 and our discussion of property income. The last couple of videos we focused on interest as a deduction and recognition as income. This video is going to talk about rental income and some of the rules around reporting that type of passive income. Rental income is profit from a rental activity included in income on an accrual basis. Cash basis is allowed if net rental income or loss nearly same as accrual method. The reason they allow the cash basis is because rental agreements, especially those around apartments, you normally pay on the first, and then that rent is supposed to last the month. You pay December 1st, and then that income would be recognized through the month. So when we get to December 31st, conceivably, all rental amounts collected can be applied. Um, so if so the accrual basis would only really be different than cash basis in this scenario is if someone's either hasn't paid their rent or has prepaid a certain amount of rent. Maybe they've paid 6 months up front. That's really the only two situations. If you are collecting rent on schedule, your accrual basis and your cash basis will functionally be the same. So you can use cash basis only so far as it's expected to match the accrual basis. Deductions from rental revenue can relate to the interest on the mortgage of a property, the utilities you pay, the property taxes, repairs and maintenance, and management fees. Management fees being, if I have a rental property, let's say it needs some repairs and maintenance, and I don't know how to do that. Or I work during the day. And so if something happens at one of my rental properties, I can't get to it as, the drop of a hat or at a moment's notice. So management fees is I pay someone to kind of keep track of my properties. If someone has a complaint or if something gets broken, they don't call me, they'll call the property manager and that manager will make arrangements. That manager might also be part of the responsibility to collect the rental amounts and remit back to me. So management fees are me sort of outsourcing the administrative tasks to an individual, and those expenses can be deducted. CCA is allowed, but it's restricted. Do we go into the restriction? Yes, we do. Buildings acquired after 1987 each fall into their own class 1 at 4%. If acquired before 1988, it was a class 3, but given that 1988 was almost 40 years ago, you very rarely see houses that are still in that class. Enhanced CCA rate for new buildings, which is 10% or 6%, used more than 90% for non-residential purposes. So that 10% is mostly it's mostly restricted for manufacturing facilities, but they have allowed it to be used for apartments, for new apartments that are being put in to assist with housing units or the housing crisis these days. An election is made to include it in a separate class 1 when acquired. Only building is eligible for CCA, not the land, and a separate class for each rental property acquired after 1971 with a cost greater than 50,000. Almost all buildings these days are more than 50,000. So in this day and age, you will always have buildings or each rental property in their own CCA class. But the thing about CCA is when you have a business, CCA can be claimed. You do your calculation, I can claim up to that maximum. And that could result in a business loss. That business loss can either be directed towards another source of income, applying it as a non-capital loss, or it can be carried back to a previous year of business income. Rentals can't do this. Once you have your income, say to a certain amount, CCA can be claimed only as far as that rental income gets to zero. CCA cannot create a loss, or if I already have a rental loss before CCA, I can't claim additional CCA to increase that loss. So anytime we get to a year where we have rental losses, the CCA can't be claimed. That UCC just carries on to the next year. The restriction's not applicable to a corporation whose principal business is rental and sale of real property. So if it's your business, yes, you can take CCA. If it's your property income, um, you cannot generate a loss through CCA. So in 2025, an individual acquires a rental property for $220,000. $100,000 is allocated to the land, so the business portion is $120,000. The property is rented for $1,200 per month. Condo fees are $150, property taxes are $3,000 per year, and interest expense is $8,100. So we go through the income amounts. If the monthly rent is $1,200 per month, and we have 12 months in a year, it's expected we would collect $14,400 of rent. That's our income. We can then deduct certain expenses, our taxes, property taxes, the interest on the loan, 81, and the condo fees that we're paying for the upkeep of the property, another 1,800. So from the 14,004, we pay 12,900 in expenses. So our net rental income is just $1,500 for the year. Our building is worth $120,000. At a CCA rate of 4%, we could deduct up to $4,800. Our CCA calculation says that's how much CCA we can take. But our income is only $1,500. So we cannot claim more CCA than our rental income amount. So even though our calculation says we can claim 4,800, we're limited to the rental income. Once that income hits zero, we're done. So our maximum deductible CCA in this situation is now only $1,500. Maximum CCA is $2,400 if the half-year rule is in place, but for now, that's not a concern. So maximum deductible CCA is limited by the rental income we're reporting. So in this exercise 7-6, Miss Sheila Horn purchases residential rental property in September of 2025 for $685,000. $142,000 of that price is for the land. So 685 minus 142 is 543. 543,000 relates to the building. She immediately spends $3,500 to make major capital improvements to the building. So our building is 543,000 plus $15,000. That's what they said. 35,000. Whoop. $35,000 of capital improvements. Our entire purchase to the building is 578,000. At 4%, our maximum CCA would be over $23,000. The gross rents for 2025 are $17,002, and rental expenses other than CCA is $15,100. This is the only rental property. What's the maximum CCA? So we could take a very large amount of CCA. Our calculation at 4% says we could take $23,000, but our rental income is very low. We had 17,200 of revenues. We had costs of 15,100. So our net rental income is only $2,100. So despite there being $23,000 of available CCA, we cannot take more than the $2,100 available to us, because once that rental income gets deducted to zero, we're done. So 23,120 minus the $2,100 of CCA we actually take, that 21,000 of CCA that we didn't take it remains in the UCC and moves forward to next year. So that's basically the whole question. There's the total purchase. There's the cost. Improvements 3,500. We calculate the maximum CCA. We get to maximum CCA of $23,000, but we can never take more CCA than our rental income. So since our rental income is $2,100, that's as much CCA as we can take, because our rental income hits zero. So that's the important factor to know about rental income, is because these properties are quite valuable, they do result in high CCA calculations, but normally landowners just don't take the CCA on buildings. One, it complicates their sale later down the line, and two, they are restricted from really claiming the full CCA amount. So make sure you understand this calculation, because that might come up in the quiz or final exam. There's an additional caveat for rentals, and it comes to short-term rentals. In the age of Airbnb, the prominence of that company or that style of renting out uh, properties has complicated the structure of this tax treatment a little bit. So rules are designed to penalize short-term rentals of residential properties situated in cities and municipalities where they are either prohibited or they're allowed, but the property owners have not satisfied registration permit or license requirements. Because short-term rentals, Airbnb, Verbo, these houses, investors are buying up these properties and they spend a fair amount of time sitting empty because they're waiting for bookings. So, in order to combat, in the time of a housing crisis, in order to combat this treatment, some cities have stated that they won't allow Airbnbs or will only allow, say, a certain number of Airbnbs. And to get in, you have to register or you have to pay some sort of fee. So, individuals who are housing or who are collecting rental income from Airbnbs in areas where they're not supposed to be will be limited in the expenses they can deduct against the income. So the penalty is they cannot claim rental expenses for the non-compliant portion of their income. So that formula is A times B divided by C. B is the number of days in the year the property was non-compliant. C is the number of days that the property is offered as a short-term rental. So let's say I had a short-term rental for 200 days and the entire time I'm non-compliant. So that creates one. One is 100%. So A is the total deductible rental expenses. B minus C is the portion that cannot be deducted. So if I have a non-compliant rental, I cannot claim rental expenses. I have to report the rental income. It's still a source of income, but this rule says I can't deduct anything against it. So I might collect $20,000, pay $12,000 in expenses, my net income is 8,000, but because the house is non-compliant, I'm still paying taxes on $20,000, the full revenues, not the 8,000 of net income. So they do this to encourage individuals to either legally register their short-term rentals or disincentivize having short-term rentals, leaving more houses for the open market. So let's say, so in that example, I used 100%, but let's say I had the house for 200 days. It was, let's say I took a month. It took me a month to get it non-compliant, or sorry, it took me a month to get it registered. So it was only non-compliant for 30 days. 30 days of the 200 days it was available. I'm only non-compliant for 15%. So of my expenses, I can still take 85% of them. So if my expenses were $2,000, so times $2,000. So my expenses are 2,000, but I can't deduct $300. So I can still deduct $1,700. So this portion is figuring out how much of my total expenses are non-deductible, how much are going to be restricted. A short-term rental is defined as any residential property offered for rent for a period of less than 90 consecutive days. This isn't an apartment. This is a short-term rental. This is an Airbnb. These rules started in 2024. Transition rules added if reason for noncompliance is because of failure to obtain necessary registration. That's only because these rules just came in, so they gave people time to get their noncompliance registration. But as we're into 2025, this doesn't really apply. So short-term rentals, this is the portion, figure out what portion of the year it was non-compliant. That's the percentage of their expenses that they're not allowed to take. Okay, so that's short-term rentals. When we come back in the next video, we're going to get into a more complicated subject, corporate dividends. I have shares, I'm collecting dividend income. How does that affect my taxable income? Thank you for your time. See you in the next video.